Have you ever wondered what makes some loans easier to get, or why interest rates can vary so much, even for similar amounts of money? Understanding how lenders think about risk is key to navigating the world of borrowing and finding the right financial solution for you. Lenders view secured and unsecured borrowing primarily through the lens of risk. A secured loan is seen as lower risk because it is backed by collateral, which is an asset you own, such as a car or a home. If you cannot repay the loan, the lender can take possession of that asset to recover their money. Unsecured loans, on the other hand, have no collateral and are therefore considered higher risk. These loans are approved based on your creditworthiness and ability to repay. The fundamental reason for this difference in perception lies in the lender's ability to recover funds in case of a default. With a secured loan, the collateral acts as a safety net. For example, if you take out an auto loan, your car serves as collateral. Should you fail to make payments, the lender can repossess and sell the car. This significantly reduces the lender's potential loss. For unsecured loans, like personal loans or credit cards, there is no specific asset for the lender to seize. They must rely solely on your promise to pay, making a strong credit history and stable income crucial for approval. For you as a borrower, this distinction has several practical implications. Because secured loans present less risk to lenders, they often come with more favorable terms, such as lower interest rates, longer repayment periods, and potentially higher borrowing limits. To get a secured loan, you typically need to pledge an asset. Unsecured loans offer greater flexibility since no asset is tied to the debt, but they often have higher interest rates to compensate the lender for the increased risk. Your credit score and debt-to-income ratio play a much larger role in determining your eligibility and terms for an unsecured loan. When applying for a secured loan, the lender places a lien on your collateral, which is a legal claim until the loan is fully repaid. This means you cannot sell or transfer the asset without the lender's permission. Understanding your creditworthiness, which is a lender's assessment of your ability and willingness to repay debt, is vital for both types of loans, but especially for unsecured borrowing. A good credit score demonstrates a track record of responsible financial behavior, which can improve your chances for better terms even on unsecured products. Additionally, successfully managing a secured loan can positively impact your credit history, potentially making future borrowing easier and more affordable. Ultimately, the lender's approach to secured versus unsecured borrowing comes down to managing their exposure to risk. By understanding this core principle, you are better equipped to evaluate your own financial situation, decide whether pledging an asset makes sense for your goals, and choose the loan type that best aligns with your needs and financial capabilities, potentially securing more favorable rates and terms for your borrowing journey.